Uber recently hit all-time highs, and that's great for investors. But I want to study this move because it's got a vital lesson about time until expiration. When trading options, people fixate on the strike price, but often overlook the expiration date. And when that happens, traders can be burned. How many of you have ever ended up losing money on an options trade, even though you were right about the direction? I'm Bret Kenwell, the US Investment and Options Analyst at eToro, and I've been there too. We come up with a thesis and think it'll play out quickly. And a lot of times, the move we're looking for does happen. It just takes longer than we expected. And by then, our options position pays the price. This case study with Uber will really help put things into perspective as you look for your next trade. So let's get into it. I'm going to pull up the chart of Uber and go through the move, then pull some options charts into the mix and highlight exactly what I'm talking about. This is Uber's overview page on the eToro app. I'm going to head over to the charting tab, and then I'm going to go into the pro charts because that's a little bit easier for me to mock everything up. And I already have my notes in it, so it'll be a little faster that way. You can see here that Uber's had a very great trade to the upside. Initially, it was finding resistance in that $81 to $82 area, and that goes all the way back to February 2024. We had a little bit of a false breakout, and you see how quickly it gave this level back up and was unable to get back above it. That was a clue for technical traders that this breakout was not ready. Fast forward to February 2025, and we again have resistance. But a breakout later in the year found this area to be support. And then Uber was able to rally to new all-time highs before pulling back to, again, the $81 to $82 area. And it did so again later in the month of June. So we have multiple times now we see this area holding up as support. So where does this go wrong from an options trading perspective? I'm going to throw on a couple vertical lines, and that'll help highlight where these expiration dates are. So one was June 20th, and the other one I'm going to focus on is actually going to be in July. And that's going to be July 18th. Get rid of those for a minute. Now, when we have this breakout to the upside and we have this nice controlled pullback to the downside, it was a notable pullback. It still faded a decent amount, but it was contained. And support came into play where it needed to be. We started to get this move to the upside. And some people might say, some people, a little bit more aggressive traders, might be buyers into this dip looking for that support. They don't know that it's going to be support. It could end up being like this again. But these traders, aggressive traders, could step in this area. Some might wait for a confirmation to the upside, and others, they might wait for something that's, a little bit closer to a breakout over downtrend resistance. This is a little corrective phase, and now we got to push through. So that's on June 6th. A lot of traders, and this is a common mistake, but a lot of traders, unless you're very nimble, I guess I should say, quick traders, nimble traders, the ones who are in and out very fast, they can take advantage of these sometimes, but the timing has to be much more precise. The mistake a lot of people will make is they would pick something like the June monthly options expiration, which gives it still about a couple weeks for the move to play out. But as we saw this move, this initial breakout, this initial rally, it fizzled out. And it's actually pretty healthy price action, okay? It pulled back to the 50-day moving average. It pulled back to the prior breakout area, and it found support. That's great stuff. But if you're in this expiration, if you're in this June expiration, and say you're long the $85 calls, which is right about here, that means they expired worthless. On the day of expiration, this closed at 83.60. That's below the 85 strike, meaning it's worth $0. If you were instead in the July 85 saying, I believe Uber will trade up through 85, but I'm going to give myself some more time to make sure that this thesis can play out. Of course, no one could have expected this. No one could have anticipated that happening, this nice big 7.5% jump on June 24th. But we were involved. We were able to stay involved with this because we're in the July expirations. And you can see that we still haven't even gotten to the expiration date yet. It's still a couple weeks away, or a couple of sessions away, excuse me. But yet the stock continues to trade really well, consolidating in the mid $90 range. So I'm going to pull in the options pricing now, which will compare the June and July's. The white is the June expiration. The yellow is the July expiration. You can see that they trade pretty much in tandem, and that's to be expected. They are both an upside position, or an options position looking for upside in the stock. The only difference is because the July expiration has more time left on it, it's going to have time premium built into the options pricing. So the sort of the downside to using options in this manner, using a longer dated options, you're going to pay more for that option. You're going to pay more for the time. But the upside is you're giving yourself more time for the move to play out. And you can see exactly how this played out with Uber. If someone waited for, and I'll try to shrink this up so we can kind of use both charts at once. But on this breakout here, this is June 6th. Coming into here, June 6th. So this is right around here, right in this nice little pop. You see that the call went up, the June call went to about $3. And it traded up to about $4. So it was a good little move, a dollar move. It's worth $100 at that price. But then it quickly faded all the way down to zero. It expired worthless because of this little consolidation phase, which is, again, pretty healthy price action. Now, if you look at the Julys, it's not as if the Julys didn't lose value. They did lose value, but they weren't worthless when we went into expiration and then eventually caught this upside move. So yeah, it was nice to go from $3 to $4, or even, maybe from $2.50 to $4. That's a great move. That's a nice trade. But it's a lot nicer, I think, to see this option trade get up above $10. That means it's worth more than $1,000 a contract. It even pushed up to $1,200, I believe, on this move to the upside. So there's quite a bit more value in the July calls. Instead of getting a 33 to 50% return on the June calls, which is a great trade, you're looking at something that was closer to the 200 to 300% gain on the July options. It's not to say that this type of trade would play out this way every time. Of course, Uber could have continued lower and can still be moving lower in other worlds, in other scenarios, and that would make this call eventually worthless. Now I'm going to pull in one more, which would be a spread, because some people might say, well, the July call is nice, but I don't want to pay that much more for it. One way to combat that would be with a spread. So a bull call spread, as a reminder, and for those who aren't as comfortable with options and option spreads, remember, you can always go to the eToro Academy where we go through these things on a more granular basis. But when we're looking at something like a bull call spread, that's where we buy a lower striked call, say the 85 call to stay consistent, and we sell a higher priced call. We'll say in this case a 95. So we bought the 85, and now we're selling the 95 against it. Creates a $10 spread. We pay a debit. Our maximum value we can extract from that position would be if Uber expired above the top of the strike. So in this case, above $95 on the day of expiration, we would get that $10, the $10 difference between the strikes minus the debit we paid for the trade. Now you look at something like this spread, the 85-95 July spread came into the month a little under $3, into the month of June, excuse me. And it too followed a very similar path to this. It had an initial pop and then a pullback. Initial pop and a pullback. That's expected. But then, because we're in the Julys and we can participate in that big upside move, we're seeing a huge move in this spread. Now it's up to over $8 for the spread. It has a maximum value of 10. Investors can always decide to take profits along the way or exit when they would like. Maybe they don't want to wait to see if the spread will be worth $10. Maybe they say a lot can happen between now and expiration. But they decide, hey, I might take profit now. Or they might say, I'm going to see this through to expiration. It's really up to the investor in this case. But my point being, time until expiration gives the trader more time to see these moves play out. And if they don't want to pay that extra premium for the options trade, they can consider doing something like a call spread. That's my little lesson on time until expiration. I think a lot of us always think when we see a nice technical setup that the move's going to play out really quick. Even if you were an aggressive trader and you were involved down here, that might seem like a good play to be short dated. And those options can move really quickly. But it doesn't give you the necessary time to see how trades can play out over time. And I think that becomes so important when we're looking to pick our options and picking our expiration dates. I hope this was helpful, and I hope it's able to help your future trading endeavors. Thank you.